So let's start the topic called business valuations. This is also sometimes this is also reported as equity valuations. At times it is also called as equity valuations. Equity valuations. So business valuation or equity valuation, both the terms will be discussed in this lecture. We'll understand the valuations such as property valuation. You must have heard that word, property valuation. What do we do in that? We try to value the property. We try to compute the value that should be paid for the in return of buying the property. Similarly, in this reading, our target would be towards valuing a business or its equity, valuing a business or its equity, or its equity. Now, one can question me, a student can question me, sir, that a business, if business is a public listed business, if it is a listed business on a stock exchange, so then you can easily derive the value of that business by looking at the market value of the share. My answer would be then that is called the market value. And we all know that market value, it is not necessary that the market value will reflect the true value of the business. Such as, let's for a second, it's not a business, but let's take the example of bitcoins. There was a time when bitcoins used to be, marketed at $18,000. A person who's looking at the market value is $18,000. But, in a very small passage of time, the value dropped. It dropped as much as 300% maybe. It went so much down. So that means that market value determination depends on demand and supply. As being a financial analyst or a funds manager, you're not supposed to, or you're not interested in the market value. Instead, you are interested in the intrinsic value. Intrinsic value. So what is intrinsic value? This is called the true economic value. True economic value of the business or a equity. So you are basically interested in the true intrinsic value. Again, I'm calling that case again, bitcoins. If some analysts must be remembering that analysts used to say that this is right now, there's a bubble of Bitcoin. This is not the true economic value of Bitcoins. That value went up just because of the hype. People started demanding it, but its true economic value is far beneath it. And hence it dropped in the value. So in this reading, we will not be computing the market values, or we will not be interested with the values that are reported on the stock exchange. We are computing the value as such, which is the true economic value of the business or of the asset. Second question that may come in your mind: why are we doing this? Sir, why are we calculating the values of business? Calculating the values of business and its equity. So obviously that question can come up in your mind, that why is there a need? Let's discuss its reasons. We all know in real world mergers and takeovers occurs. Mergers and takeovers occurs. What do we mean by that? One company, company A, will either merge with company B or take over the company B. That means company A will be buying the company B. Hence, in that case, business A is buying the entire business B. At some events, an ordinary person can go and buy a business of a different, such as, you know, companies could, we can take the example of Facebook acquiring WhatsApp. That was the example of a company acquiring a WhatsApp. Like, let's suppose in Pakistan, Mia Mansha, must have heard the word of that. He buys lots of companies at times. So obviously, the person who is buying, the person who is buying the other business has to compute the value, has to compute the value of the other business. There can be other reasons as well. Like, let's suppose one reason could also be due to investment. Like, let's suppose you want to buy a certain portion of share of one company. So if you are an investor, you want to buy some amount of shares in company B. In that case also, instead of buying it at a market value, you would like to compute its real value, because in the market, the value can either be overvalued, the value can either be undervalued, and more. There are various reasons that we go through business valuations and equity valuations. Majorly, the reason is takeovers or mergers. In that case, we have to compute the value of another business or value of another business equity. Now, our prime focus will shift towards, sir, how do we value? What do we need? And how is this done? Right? So let's go through a little process of it, and then further we'll understand. So moving forward, how to value the business, how to value the business. If we start the process of valuing a business, let's suppose you are a person A, you want to take over business B, and you want to compute the value of business B. How do you start off? Obviously, the normal way to start off is that you need to gather some information. Without gathering information of the business B, you cannot start off. So gather information of business B. What is the prime information that you can gather? Obviously, the financial information, such as income statement, such as the balance sheet, and the other financial statements such as SOSHI and other financial statements. So you'll gather the financial statements of business B. Once you have gathered that, then you'll try to compute or calculate the value of the business by using the data that you have extracted from your financial statement, such as income statement, balance sheet, and statement of changes in equity. The second would be then to apply different valuation methods. To apply different valuation methods. So second would be to apply different valuation methods. So that means there are more than one valuation method. There's not only just one, there are more than one valuation method, and each method can give you its estimate. We're going to discuss that as well. What different methods do we have? Basic three methods we have. Number one is said to be net asset valuation method. Net asset valuation method. Number two is said to be cash flow method. And number three is said to be income based methods. Income based method. So one is the net asset valuation method, which is very simple and straightforward. Market value of assets minus the market value of liabilities, after which we get the value. A very basic idea. Cash flow method is very simple. For in the cash flow case, the value is equals to the present value of future cash flows. Present value of future cash flows. In the cash flow method, we are going to study two types. One is said to be the major type, dividend valuation method, because one type of cash flow that the company pays to its investors are dividend valuation method. And the other method we'll study is free cash flow method. Free cash flow method. In either case, the concept will remain the same. If it is dividend valuation method, we will be computing the present value of the future dividends. If it's a free cash flow method, we will be computing the present value of the future free cash flows. Then comes third are the income based methods, such as price to earning ratio basis or price to earning ratio method, and earnings yield method. Earnings yield method. We'll understand that also. So if we see, you have basically five methods. One is net asset valuation. Number two is dividend valuation method. Number three is free cash flow method. Number four is price to earning ratio method. And number fifth is earnings yield method. So basically you have five methods. If you can see, you have five methods. Okay. So if you want to write something down, you can write as well. So now let's understand one by one the different valuation methods. So I'll be starting off, the first one is the net asset valuation method. So I'll be starting off with that. Valuation methods. The first one, the most simpler one, is called the net asset valuation method. Net asset valuation method. So it's simply, we are just looking at the remaining net asset value. One way of valuing a business is that how much net assets are left out for a business. To compute this is very simple. Market value of assets excluding any intangibles. We do not consider intangible assets such as goodwill. We do not consider intangibles such as goodwill, copyrights, patents. We do not consider intangibles in the net asset valuation. So we exclude the intangibles from the assets, and then we deduct of market value of liabilities, and we get the net asset value of business. Or just say net asset value. If we want net asset value, this is also called NAV. If we want it per share, that what should be the value per share, we can divide this by number of ordinary shares, and we'll get NAV per share. So usually we take market values. If market values is not given to you in a question, then we assume that book values are equivalent to the market values. If market value not given. So like let's suppose you have been given property value, only balance sheet data has been given and no other market values are given. In that case, we assume that the book value will be considered as the market value. So this is called the net asset valuation method of a business. What are the advantages? The good thing about such a technique is, advantage of such a technique, at least you'll be able to compute or you'll be able to calculate the floor value of a business. What do we mean by floor value of the business? The minimum, at least the net asset value is the minimum the business will take from you. That's the minimum you're getting out of the business. That's the minimum you're getting out of the business. Number two advantage is that it is usually used for asset stripping. Asset stripping. Stripping simply means whenever you are selling off your business, scrapping your business. In that case, obviously, which valuation method would be used? Net asset valuation method. But along with that, there are certain disadvantages too of this method. Number one is that it ignores intangible. It ignores intangibles. So if a business has high amount of intangibles, such as KFC. Now KFC business has a huge amount of goodwill, huge amount of brand name. Now if I want to go and buy KFC, I will not just calculate the net assets of the KFC business and ask them, bhai ye aapke net assets hai, let's take this money and give me your brand name, KFC. Obviously they will charge for their brand name. They will charge for an intangible. So any businesses which have heavy amounts of intangibles, for those businesses, this is not a suitable method. But for example, let's suppose take a haircut shop, hairdresser shop. Now, usually haircuts or hairdressers on the streets do not have intangibles. They don't have big brand names. So whenever you are going to buy their shop, obviously you will check simply the net asset value you're getting from them, and you'll charge them that. So for those businesses who do not have intangibles, for those businesses, net asset valuation can be used. So one of the major disadvantages that it ignores intangibles, and two, Usually whenever you go and try to buy the business, you do not see the current status. So basically, this advantage is that in net asset valuation, it is showing you the current status of the net assets, current status. However, buyer is more focused towards the future potential, is more focused towards the future potential. So the buyer is more focused towards the future potential. But as I said, net asset valuation is more keen towards what? Current status of the value, current status of the value. So these are certain advantages and disadvantages of net asset valuation method. Next, let's slightly take an understanding of dividend valuation method. Number two important method is dividend valuation method. Dividend valuation method simply defines it, it tells you the value of equity is equals to the present value of future dividends, present value of all the future dividends. So that's the value of equity. It gives you the value of equity, not business. First, let's derive a difference between equity and business. Business means both stakeholders, equity plus debt, equity plus debt. Whereas equity only means one stakeholder, which is just shareholders, equity shareholders only. So we are computing the value of equity in dividend valuation method. Present value of future dividends. So if we have all the future dividends at time zero, if we have all the future dividends, we just need to compute their present value. That present value will be equivalent to the value of equity. If you are taking dividend per share, then obviously the answer that you'll get will be also per share. If you are taking total dividends in each cash flows, the answer will also come in total wise. Let's understand this in more detail. So let's suppose there's a company. It pays each year dividend per share of $10 each year. So there's no change in dividends. Each year it pays the same dividend, $10. And you are asked to compute the value of company equity. How would you do that? Simply by computing the present value of all the dividends. Because the same dividend will be paid in the future years, we can call this as perpetuity. This becomes a perpetuity, a cash flow, same cash flow occurring again and again forever. Such a cash flow is called perpetuity. And the present value of computing a perpetuity is simple. Cash flow divided by discount rate or the interest rate. The discount rate over here would be used as the required return by equity holders. Required return by equity holders, and such a return in the WACC was called cost of equity. Cost of equity simply means the return that is required by the equity holders. So let's suppose cost of equity is said to be 10%. So how am I supposed to compute the value of equity? Simply the cash flow is dividend in my case, which is $10 divided by zero point 0.1. So $100 is the value of equity per share as per dividend valuation model. So dividend valuation model suggests the company per share value is $100. So I've just drawn a basic idea that how do we compute value in dividend valuation method. Further now, let's make it more complex. We know, you and both of us know, that company do not pay a constant dividends to its common shareholders. A constant dividend is paid to a preferred shareholders, but not common shareholders. So companies do not pay dividends to its common shareholders, right? Fixed dividends to its common shareholders. So that means dividend will not remain fixed at 10. It might be 10 today. It might be 12 next year. It might be 13 next year. It might be 15 next year. It might be 18 next year. So that means the dividend will not stay the same every year. It will grow. The dividend will grow. Now, so what to do in that case? If the dividend is growing each year, what to do? The first thing you need to do is to compute the sustainable growth rate. Sustainable growth rate that will remain the same in the coming years. Compute the sustainable growth rate. The formula slightly changes. This is the real case. This is the real scenario. Now you want to compute the value. Simply the value would be, value of equity will be equals to, I'm taking the next year dividend, D1. As I did in the perpetuity formula also, I took the, if I am standing over here, I took the next year dividend, which is called the D1, divided by cost of equity. That's what I did over here as well. The only change is that in this case, I have growth also. To incorporate that growth, I will be minusing growth in the denominator. That's the only adjustment you need to do. This is called the Gordon growth formula. Gordon was a person who introduced this concept. So the only change you need to create is deduct growth in the denominator. So now you can see, does it make sense? If there is a higher growth of dividends, obviously the value of the company should also be higher. So let's see, if I increase growth, overall denominator will decrease, hence overall value will increase. So you can see the growth and the value has the same relationship. This is how you compute the value of equity through dividend valuation method. Let's understand how key variables can be computed. Number one is D1. D1 is simply means D naught multiply by 1 plus growth rate. D naught means the current dividend. If I add up growth and multiply by that, I'll get the next year dividend. That's how I compute D1. The other factor is KE, or we can say, let's say we have growth. So let's understand how can we compute growth. One way of computing growth is using this formula, return on equity multiply by 1 minus dividend payout ratio. So one formula is this, return on equity multiply by 1 minus dividend payout ratio. This is also called retention ratio. This is also called 1 minus DPO, which is dividend payout ratio. 1 minus dividend payout ratio is also called retention ratio. Now let's make some sense. Let's suppose you earn $100. You made an earning of $100, from which 60% is paid as dividends. 60% is paid as dividends. So how much did you retain? You retained only 40%. So you retained only 40%. That 40% amount will grow. By what rate? by the rate which is called return on equity. That amount will grow. The rest have been paid. That cannot be grown. So that's why we multiply both of these to get the growth rate. Or there's another way also, which is or number second way, latest dividend paid divided by earliest dividends divided is to the power of 1 upon number of years, the difference between latest dividends and earliest dividends, minus 1. If you're not given such data, then you can use this formula. Very simple. Latest dividend that has been paid divided by the earliest dividend is to the power of 1 upon the number of years between the latest dividend and the earliest dividends, minus 1. Minus 1. Let's do it in a very small example. A very small example. So I'm taking an example on growth rate. So very small example. I'm using the first formula right now. You have been given the return on equity 20%. You have been also given the dividend payout ratio 60%. So using the first formula, how do you compute? Using the first formula, how do you compute the growth rate? Very simple. Return on equity is 0.2 multiplied by 1 minus 0.6. So 0.6 into 0.2. So 0.6 into 0.2. Sorry, 0.4 into 0.2, which is 0.08. So answer is 8%. This would be used as growth. If such a data is given, use the first formula. You can also be given the other data as well. For example, instead of the question hasn't stated the return on equity, neither it has given you dividend payout ratio. Instead of that, they have told that they've given you dividends of last 5 years. Last 5 years. So the current dividend is $5. Last year dividend is $3, then $2.5, $2, and $1.75. So we can say you have been given data. So this is the current year, and these are last years. So you have been given data of how many years? 1, 2, 3, 4, 5 years data. 1, 2, 3, 4. So you have been given 5 dividends. Now you need to see me carefully. How do I solve this? Which is the latest dividend paid? That is $5. So I'll say 5 is the latest dividend divided, which is the earliest dividend paid, which is 1.75, is to the power of 1 upon the years, number of years different between the earliest dividend and latest dividends. Yes, they have given you 5 dividends, but if you count the difference of years in between them, that is how many? 4-year difference. So this 1.75 has grown to 5 in how many years? 4 years. So it is 1 upon 4 minus 1. You will again be able to compute the growth rate. Do let me know what is the growth rate. So we have understood how to compute growth. There are 2 different formulas for that. And I will move further emphasize on the second formula. Let me give you another example of it. So let's suppose the example number 2. Example number 2 is given to you be as last 4 years, 5 years data has been given. So one dividend is given to be $2, one is given to be $6, one is given to be $15, then $18, then $20. So these are the current year is this one. So these are the past years. So current is this one. Rest are past years. So the current dividend you paid was 20. If we start from the last year, it started off from 2, then it shifted towards 6, then 15, then 18, then 20. Now how do we compute? Now I want your full attention, please. Full attention. Whenever we are looking for latest and earliest dividend, so latest dividend is obviously 20. I'll use that as it is, 20. But for earliest dividend, I have to take such a dividend at which the growth became sustainable. Because what type of growth am I calculating? Sustainable growth rate. If you see the first 2 years, the dividend was 2, then it jumped up to 6, then it jumped up to 15. After 15, the growth started to show sustainability. Before that, the growth was fluctuating from 2 to 6, 6 to 15, and then suddenly I can see 15, 18, and 20. This is the period I will be considering, because in this period, the growth seems to be sustainable. This usually happens when a new company is launched. Early on, dividends are not sustainable. We cannot use that into computing the growth rate, because that will affect our sustainable growth rate. So for in this case, our earliest dividend will be $15. And how many years the growth remains sustainable? 1 and 2 years. So divide s to the power 1 upon 2 minus 1, and you'll get the growth rate of this sustainable growth rate of dividends. So we have discussed how to compute the D1 variable. We have discussed how to compute the growth. The third variable is the cost of equity, or the required return of the equity holders. How to compute that? One way is to use the CAPM that you studied in VAC of financial management. CAPM is one way to compute the cost of equity. Simple formula. I'm writing down the formula: risk-free rate plus beta into market risk premium So risk-free rate plus beta into market risk premium. That's one way to compute the cost of equity. What is market premium, sir? Market premium is equals to market return minus risk-free return. That's called market premium. Through this formula, you can compute the cost of equity. As I said, you must have studied this in the VAC topic of financial management. Another way to compute cost of equity is bond yield. Take the bond yield plus add a risk premium to it. A risk premium. Bond yield does not have enough return on it as compared to equity, because its risk is lower. So what happens? You add up a risk premium on it, then also you can compute cost of equity. One way is that of computing a cost of equity. As we'll go through the questions, these workings will start to make more sense. Once you've got these variables, then it's very easy to compute the value of equity. So let's do one basic example and then we'll move towards good questions. So one basic example. Let's suppose you're given return on equity 20%, dividend payout ratio is given to be 60%, you are given risk-free rate of 12%, you are given market rate of 20%, you're given beta of 1.5. So you are asked to compare the current dividend that you have just paid is $5 per share. You're asked to required is compute value of equity per share. Try this. I'm giving you 5 minutes to try this question. So let's try this question using the dividend valuation equation formula, which is T1 divided by KE minus G, and I'll get the value of equity. So if I am using dividend per share, I'll directly get the value per share. If I use total dividends over here, total dividend value, I'll get the total equity value. So my over here, I've been given per share value, so directly I'll get equity value per share. So let's solve for the variables. D1 is equals to current dividend, which is 5, into 1 plus G. I don't have G right now. I need to compute G for that. G is equals to return on equity multiplied by 1 minus DPO. So if I solve this, 0.2 multiplied by 0.4, this would be 8%. So I can plug in growth over here, 0.08. So 5 into 1.08 is equals to 5 into 5 into 1.08. 5.4. The next year dividend is 5.4. And the last thing I want is cost of equity, which is the required return that would be taken out by the equity holders. The risk-free rate is given to be 12%. 12 plus beta is given to be 1.5. And market risk premium is the difference of market return and risk-free rate. So 20 minus 12. The cost of equity I'll be getting is 8 into 1.5 is 12, 12, 12, 24%. Now I have all the three things. Now I can easily compute the value. 5.4 divided by KE 0.24 minus growth is 0.054. Use in decimals, okay, always, because those were percentages. So when you compute this answer, so 0.24 minus 0.054, that's 0.186. 5.4 divided 0.186. The answer that I'm getting is 29.03. Counter check it. 29.03. Counter check. Pardon me, I've used incorrect growth rate. Human error. So growth is 8%. Sorry, it's 8%. So it should be 0.08 over here. So the answer would then be 0.24 minus 0.08, which is 0.16. 5.4 divided by 1.6. 5.4 divided by 1. 33.75. 33.75. This should be on. Third method is the price to earning ratio method. Price to earning ratio method. It's a very simpler method, an easy to understand method. What we do over here, we will be using the earnings of the company to compute the value of the share. So we'll take the average price to earning ratio of industry or slash that sector in which the company is operating, and we will multiply by the earnings per share, the current earnings per share of the company. So I'm using the current company earnings, but the price to earning that I'm using is of industry or sector. So I'm using an average price to earning ratio and multiplying that by the EPS or earnings per share of the company. That will also give me value per share or price per share. Value per share or price per share. Usually in ACCA, we at times interchangeably use the word market value also for these valuations that we are computing, such as the value we computed over here. At times, the ACCA calls it the market value also, because for us, this is the true market value. For us, for the analyst, this is the true market value. Price to earning ratio method, advantage is that it is very simple, easy to use. However, we will definitely go through those advantages in detail afterwards. Okay, so we have taken an understanding of very basic three methods: net asset valuation method, dividend valuation method, and price to earning ratio method. Now I would like you to apply this method into a question. So now this is the question in front of you. I want you to compute this. This is the complete question. Question name is closed company. Read this question. You need to calculate the value of closed company using the following methods. Now I want to clarify something. Whenever the question says calculate the value of closed company, you need to compute the total value, not value per share. Unless and until it is stated that you need to compute value per share, otherwise you will always be computing the total value. Total value means total value of the equity, total value of the equity using all the three methods. So you are supposed to compute the value of closed company using all the three methods: net asset value, dividend growth method, and earnings yield method. I'll describe this method to you. I haven't taught this method as yet, but at least do the first two, one and two. Do the first two. Try. I'm giving you 5 minutes for this. Try this question. So let me solve this question. The first thing I'm using is the net asset valuation method. Net asset valuation. So I'm computing the NAV, total NAV. So for that, I've been given the assets, current assets. So this is the book value of assets. Do I have any assets which value differs from the book value? No. So I'll consider book values as similar to market values. So total assets are given to be 720. There are no intangibles that I had to deduct, so I'm directly deducting the liabilities. So 720, and the liabilities that has been given to me are 160 is this, and current is this. So 160 minus 70 current minus 160 non-current. The value that I'll be getting after that is 490. So dollars 490 million is the total value of closed company equity. And if you want per share value, it's very easy, just divide by number of shares. You'll get the per share value. But over here, they have been asked us for per share, they've asked for total value. Now, the part two is to use a dividend growth model. Simple. And I'll use that D1 KE minus G. So the current dividend that has been paid in total form are 40 million. So in order to compute D1 is simple 40 multiply by 1 plus G. So let me see if growth is given to be. Financial analysts have forecast that dividends of closed company will grow in the future at a rate of 4% per year. This is slightly less than the forecast growth rate of profit after tax earnings of the company, which is 5% per year. The finance director of closed company thinks, considering the risk associated with the expected earnings growth and earnings yield of 11%, this is earnings yield, closed company has a cost of equity of 10% per year. So I've got all the data in this question. Growth is simply 4%. Divided by 10% is my cost of equity, and minus 4%. So when I compute this, this should give you the answer $693 million. This is the total value of closed company equity, $693 million. The third way is said to be earnings yield method. Earnings yield method. So let me try for that. Earnings yield method. For earnings yield, they've given us the earnings yield. Now I'll make you understand that. That is 11%. Now, before I explain this method, it's very similar to earnings method, price to earning ratio method. Earnings yield is reciprocal of price to earning. Earnings yield is equals to earnings upon price. This is the earnings yield, right? Earnings upon price. So you have been given the earnings yield basically, which is 11%. Now, one way is simply to convert it into price to earning ratio. How do I do that? Just the reciprocal. 1 upon 0.11 will be equals to what? Price to earning ratio. So when I do that, 1 upon 0.11 is equals to price to earning ratio. So when I do that, 1 upon 0.11, I'll get 9.091. So I'll get 9.091. This is my price to earning. This is the earnings ratio that is expected for valuation purpose. So I've got the price to earning ratio now. So simply now what do I need to do? I need to multiply by the earnings. How much earnings the company is currently earning? 66.6 million. So 66 point, which gives you the answer of 66.6 million. The answer comes to be dollars 606 million. So I've simply used the price to earning ratio method in itself. So I've simply used the price to earning method in itself. This is without growth method. This is without growth method because they have also given me the growth for earnings. So the examiner said you can also use an alternative method. Over here, what I did, I just simply used the earnings and divided the earnings yield. That's what I simply did. So I just divided the earnings yield. If you see, I just divided the earnings yield by 66.6 million. Examiner also provided an alternative, or you could have incorporated growth also, which is earnings multiply by 1 plus G divided by earnings yield minus G. Similar to what we have done in dividend valuation. D1, in D1 we have growth over here and we deduct the growth downwards also. So earnings is 66.6 million into earnings growth is 5%, 1.05 divided by earnings yield is 0.11 minus 0.05. In that case, your answer would have been dollars 1166 million. Both the answers were acceptable. This one or this one. This is with growth. This is without growth. Both the answers were acceptable by the examiner. So both the answers were acceptable. So let's try this question as another one. NN company, you have been given this data and you need to compute the value of NN company using the dividend valuation method and the net asset. Try first. Try yourself. So computing through dividend valuation model, D1 upon KE minus G. So D1 current dividends that this pay had just paid a dividend of 0.66 per share. So it paid a dividend of 0.66 per share into 1 plus G. It has a cost to equity of 12% and the dividends of company has grown recently by an average 3% per year. The ordinary shares is so into 1.03 divided by cost of equity is 12%, 0.12 minus 0.03. After solving for this, as you solve this, you will get answer of how much? 7.55. Let me know. 7.55. So you get the answer of 7.55 per share. As the question state, calculate the equity value of NN company. So it didn't state per share. It wants the total value of equity. You need to multiply by the number of ordinary shares. What's the total ordinary shares value? Total ordinary share capital is 50, and one share value of 1 is 0.5. So I divide that 0.5, I'll get the number of shares. So one share is for 0.5, so it's going to be 100. So answer would be then 755 million. That's answer through dividend growth model or dividend valuation model. Number two is net asset value, which is also very simple. Your total assets is 143. Are there any intangibles? No, they are not. Minus your liabilities, your here total current liabilities is here 29. Minus non-current liability is 20. Minus As I said, we also deduct preference share capital. One reason is that we are looking for the value for ordinary shareholders, and number two reason is that preference share capital also take a fixed charge similar to as a loan. Hence, they are also considered as a liability when we are evaluating the net asset value of equity. So I'll also minus 25. Hence, the value that I'll obtain from this is dollars 69 million. $69 million. So I've done it both ways. So I'll also add this up on in my notes. So I'm also writing this over here. You also need to minus preference shares value also, so that you get the net asset value. As I said, preference shares are also gets fixed charge, fixed dividends, so they are also treated similar to as a non-current liability or as a long-term liability. This is also useful whenever we are making international investments, and if we want to compute the value of international investments, so we use these methods. We use these valuation methods: net asset valuation, dividend valuation, earnings method. So in order to make good international investments also, if you want to make good international takeovers, mergers, or domestic mergers or acquisitions, we can use these methods. Thank you.